Okay, good morning, everyone. I hope it's a great day for all of our participants, and welcome to our engagement for today, which is part of a series we do as we try to connect with the investors, to educate, to get feedback from you as we continue to grow and develop our market. I think we can never stop saying this. A market can't happen without investors. So we really appreciate you taking off time from your busy schedules to come and learn one or two things or relearn. They say learning can never stop and it never ends. So we want to thank you. It is 2 minutes past 10, and from what I can see, we really have enough quorum to start. So our theme and topic for today really is about a reflection on how 2025 was in terms of government securities space in Uganda, and trying to see what did it mean, what were the trends that were observed, and what do they have to tell us as we are looking at 2026. So I have some really powerful ladies in the call with me today. I'll be introducing them shortly, but before we start, I will request, I believe, I'll request Susan to give us an opening prayer, and then we'll start from there. So Susan, over to you.
Okay. Loving Father, we want to thank you for this morning. We want to thank you for the engagement that we are having, Lord King of Glory, with our investors. We pray that, Lord Jesus, that the rest that are yet to join the call will be able to join, so that they are not able to miss out on any conversations, on any discussions that are being done, Lord King of Glory. We pray that indeed, Lord Jesus, you will anoint us, give us the wisdom, give us the knowledge to be able to understand each and everything that is being discussed and being shared, Lord. And also, let us be more of people of action, that after we have received this information, let us go and act on it for the development not only of ourselves, but also of our nation. And so we want to thank you, and we give you this entire day. In Jesus' mighty name we have prayed. Amen. Bob, you're muted. If you're speaking, you're muted, Bob.
Sorry. Sorry, thanks, Susan, for that. I was already rolling. Yeah, so to our audience, I'll introduce to you our very powerful ladies for today, for our panel today. So I'll begin with Susan Namaganda. Susan really has, say, close to actually over 10 years experience in the market in different roles, from brokerage to advisory to deal structuring. And I think previously she has been moderating most of these sessions. So we said, since she has been asking the hard questions, it's also our opportunity to ask her the hard questions. And she will be the person painting the picture for us in terms of what does 2026 look like, 2026, 2027, but we'll call it 2026, given that the previous year was 2026, just for purposes of this call. So don't be led when you hear us talking about as we look forward to the rest of 2026. We are referring to the financial year 2026, 2027. Now, government bonds are issued according to government financial years, and as you all know, it covers 6 months in 1 year towards the end and another 6 months at the beginning of the next year. So to put it into context. So Susan, you're welcome. I think you can officially say hi to our audience.
Hello, hello. Thank you so much, audience, for being here. And we are really looking forward to a fruitful discussion. Do not be afraid to ask any question. We are ready to answer.
Okay, so thank you, Susan. So to the audience, our second panelist is Ms. Janat Anayo. Janat has over 5 years experience in the market, and her strength and her competence is really on analysis. So she will be the one given the tough job, which we are sure she will ably deal with, analyzing for us how 2025 was, and painting for us what the trends that were noted, and maybe what they might mean, and the environment we did business in. So please welcome Janat, and Janat, you can say hi to our audience.
Thank you, Bob. Thank you, Susan. Just like you said, my name is Janet. I serve with Old Mutual Investment Group, the Uganda arm, and I hope we do have a fruitful conversation. And as Susan said, at the end of the day, we also put whatever we are going to learn into action. So thank you, and I look forward to it.
Thank you, Janet. So as is our practice, we will just start with a bit of a knowledge check and bit Q&A to understand the audience and gauge the expectations so that we try to deliver on those. So Susan, please just take us through that next segment as we all try to get to understand where we are.
Okay, so I have already in the chat section, if you go to the chat section, I've dropped there a link for us to participate. But then for those that are able to use their QR codes, I'm about to display on the screen exactly what we are going to be doing. I believe you're able to see right now on the screen. It's a Mentimeter, it's a survey, and it's really it's a fun survey. It's not like those hard surveys. And right there, for those who have a QR code, please go ahead and respond. For those that do not have a QR code, please click on the link in the chat section and you'll be able to send your responses. So the first question is like, have you ever invested in a Uganda government bond or bill? If you have, so the most of majority of we are head to head. Those that have invested before and those that haven't yet invested. So the ones that have invested, someone said that yes, but not currently invested. So one person, actually now 2 people. That means you've invested before and probably you liquidated, probably you have a treasury bill or a bond that matured, but the majority of us have invested. Banai, well done, our investors. Thank you for continuously investing. Yeah, so keep those responses coming. Then we go to the next question. Which bond tenor have you invested in most often? So most of us are saying I've done. One person is saying I've done a 15-year, another person 20-year. Let's go. 2 years, 7. A majority are 15-year bond holders. The ones who are the short term are less, but anyone above 10 years, we are thankful that most of us are above 10 years. Keep the answers coming. Yes, I see that also the shorter terms are picking up, but still the long end. So the long end there, we are talking about people who have invested from 10 years up to 25. So the majority of us have invested beyond 10 years, 10 years to 25 years. How would you rate your understanding of government bond investing? Are you a beginner? Are you basic in your knowledge? Are you intermediate? Are you advanced? Yeah. For those that are just joining the webinar, Please feel free to click on the Mentimeter quiz survey so that you can be able to engage in this interactive session. So how would you rate your understanding of government bond investing? That most of us are saying we are basic, the majority are basic. So we are glad that we are here, that we continue to teach. Others, actually, we also have a good number on intermediate, and also a good number on beginner. The advanced people are few. So that means we still have a long way to make sure that all our investors are at par and are able to fully understand what government bond investment is. And we thank God that the USC, we have been taking on this education process, and we shall continue to be able to educate our people. Then what is the biggest challenge you have faced in investing in bonds? What is the biggest challenge of faced when investing in bonds? You can just throw in there a question. Your answers. A lack of knowledge. Choice. Knowledge gap, none. Investment cost, bond prices. It's my first time. Someone is saying tax. Pricing, it's coming up. Knowledge gap really is coming. Lack of information. Insufficient knowledge. And then someone is saying, I want to know how it works. Knowing the calendar, you do not know the laddering is the challenge. You're having challenges with the laddering. Someone is saying, knowing the calendar, that means you're saying, I do not get to know when these issuances are coming out. So that's why I've faced challenges. I want to be consistent, but I'm not able to. Then someone is saying that they learned in the previous four, but what really is standing out is really pricing, bond prices, lack of knowledge. Those are like really the key things. Then also someone is saying choice. Really, I have challenges with making a choice. Then someone has said political instability. Then someone has also said government unpredictability. Yes, then someone else is saying accessibility. Yeah, timely information. Really, those are coming out. Thank you for those responses. Then what has prevented you from investing in bonds so far? And this question specifically is for those that have never invested before. What has prevented you? Those that have never invested at all. Inadequate capital, none, not knowing returns, taxes included. You do not know that taxes included. Yeah, not knowing the returns. Someone is they are located remotely. They are living outside Uganda. Then the premiums. Someone is saying that the premiums are too big on those bonds. So that is why you have not. Then you've missed the calendar days. Then the fear of fee charges. Some people are fearing fee charges. And then also some people are saying, I do not know whether to come during the primary or the secondary. So you have been challenged. Then someone is saying also it's a perception that they are expensive. That is what I get there from that. Then funds. So inadequate capital is also really starting out. So how satisfied have you been with your bond investment experience? For those that have now invested, are you very satisfied? Dissatisfied? You can even tell us, but I'm very dissatisfied with my bond investment experience. Thank God the majority are saying that they are very satisfied. Yeah. Then there are just those are just saying just satisfied. They're not very, but they are satisfied, isn't it? Yeah. One person has said that they are dissatisfied with their investment, but at least slightly. And then someone is also saying very, very dissatisfied. So we are here to be able to help you, and you're going to be able to reach out to us to be able to tell us what is really dissatisfying you. And actually, even in the chat section, because we're going to really be listening from you today. And then compared to expectation, bond returns have been better than expected. Have they been as expected? Lower than expected? Or some of you are saying not sure. Someone is saying that as expected. The majority. One person is saying better than expected. They are very happy people, isn't it? The majority also, even we're also having a significant number of those that are saying that they are not sure. They are not sure. Yeah, but at least the majority of us are saying that as expected, and but majority are saying we're not sure if that was the good deal or the wrong deal. Then do you plan to invest in government bond auctions during the financial year 2026-2027? So we are going in for the new financial year that is starting next week on the 1st of July. Are we excited? Are we ready? Majority of us are saying yes, we are going to. Someone is saying probably. Another person is saying, one person is saying not sure. But at least I thank God we have no no's. At least all of us at least are ready to go, are ready to press that button, are ready to transfer those funds so that we ensure we start our investment. Really, really, thank you for those responses. Thank you, keep them coming. Then what information would help you invest more confidently in bonds? Like, what is that one thing that you're saying? That's so that for me, if I get to know this thing properly, I'll be a confident investor. I will give you all my money. I will really, technical knowledge, process knowledge. The process, how do I invest? How do I get my money? Because at the end of the day, we need to know how I enter and how I exit. Someone is saying how it works, accurate information. Then considering the compounding interest. Some people are saying, first, we do not want to earn our money back. Please send it back so that it is compounded, money transfer. Then some are saying laddering. I want to understand that thing of laddering. We have heard of it. I want to understand it. And we are definitely going to answer what laddering is, how to do that bond laddering. Then we're going to do financial calendar. If I have access to a financial calendar, I will be able to invest more confidently. So that is what we are saying. Pricing, yields, government decision making. Some people are political on this platform. They are saying, but the change of government, do not worry about the change of government, even though it changes to a whole new party system. You lent the government of Uganda and not a political system. Yes. Secondary or primary investment versus cost. Then you also want to understand the different coupon rates. Then people are saying the political situation, that is really understandable. The calendar payment months, getting the best rate. Some people are saying, if me, I want to invest when I'm getting the best rate, really. Yeah. But really, 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 really thank you, people, for those responses. Then how did you first learn about government bonds? How did you first learn about them? Did you learn them through friends or family, commercial bank, a USE broker, social media? What was the place where you got this information from? That one, for us, as the people of Uganda, we like to invest where people are putting their money. Most of us are saying friends or family. That's a real good one. That means your friends have attended presentations. That means your friends have been probably talking to people and are passing down. So yes, actually, the service business actually is largely a referral business. Yeah, so that's a good thing. But also I also want to thank social media. By the social media and friends and family are taking that day. So that means that as the brokers and the commercial banks are not doing a good enough job to tell you about these things. So we beg to improve in the future, in the new auction season, so that we will be better at it. Yeah. So what motivated you to invest in government bonds? What was that motivation that you said, you know what, me, I'm motivated, I want to invest? What motivated you? Side income, wealth creation, security, retirement plan, side income, security, low risk, cash flow, stable returns, retirement plan. My brother is making, I think someone said my brother is making more money or something. Yeah, something like that. Yeah, so my brother is beating inflation. Independence, passive income, easiest investment avenue. Yeah, that for me, this one, I do not have to go and really go through so many processes, that it's really easy for me to deploy my money. Yeah. Yes, that is really, really good to see. But most of us, what is really coming out strongly is wealth creation, low risk retirement, security. Yeah. Someone is saying that I lend to nations. You're lending to the nation of Uganda. Some are saying predictability. Yeah. I am city alosi. You earn a living, stable returns, security of funds, steady income, liquidity. That means in the event of you want to sell that bond, you can easily access the buyer and you get your money out. That means these people who are saying liquidity are people who probably have even bought and sold before a bond. Yeah, so stable returns really is really coming out. Security, that stable income, an opportunity to earn a side income. So how long have you been investing in bonds, in government bills or bonds? Has it been less than a year, maybe 1 to 3 years or more than 3 years? Yeah, the majority, by the way, more than 3 years. Then also we have the less than a year. There are also many people who are saying more than 3 years. But we are clapping for those people. You have been consistent and diligent. Well done. But now the ones of less than a year. So that means we have very many entrants from last year. And they also 1 to 3 years. Also, actually now the 1 to 3 years are now more. Well done, our investors. Well done. So this brings us to the end of the presentation. Thank you for those responses. And really, actually, these responses are to help as we are responding to you. So we know the people that are in the room. We know that people that are here are people that have the majority have basic information of what government bonds are. The majority of us have invested. The majority of us are here looking at this as a passive income, a source of wealth creation. And so we are grateful to be able to really respond to you and to whatever questions that you'll have. I'll hand over back to Bob right now so that he can take us through to the next step. Thank you.
Thank you very much, Susan, for taking us through this. And to the team, we really always appreciate your responses because it gives us a perspective of who is in the room, but also to drive and structure the conversation. So without much more time on this, we request Jeanette to share your screen and tell us what happened in the last year. I'm sure that's what most of the people on the call are interested in knowing. How did it go? What trends did you see? So that they can understand. Because most of them were saying information is an issue, so break it down for them.
Okay, thank you so much, Bob. Just confirm that my screen is very visible.
Yes, Janet, it is okay.
Okay, thank you so much. Thank you, Susan, for that Mentimeter. I think it has given us a very good outlook of the kind of attendance that we do have and the understanding of the fixed income market. Maybe just for purposes of understanding is before I proceed with this presentation is just to sort of define how the fiscal calendar works, because you will see that we are reviewing the period. That's the fiscal year 2025-2026, which of course aligns with the government year. And that's the period that starts July 2025 and ends June 2026. So that's the period that I'll be reviewing or giving a recap of how the Ugandan sovereign market did perform. And then my colleague Susan will come in later and just sort of give us an outlook of where we see the next fiscal year that starts July 2026 and ends June 2027, on how it has evolved and the different expectations. Also, not just for your comfort as we go through the presentation, please be confident enough to ask questions in the chat room, but also we shall be sharing this presentation after the call for all those that have attended. So before I go into how we really performed on the fixed income market, one of the questions that Susan did ask was regarding compared to your expectations? How have the bond returns performed, or have they been satisfactory compared to your expectations? There was also another question on what more information would help you to invest in the fixed income market more confidently. Now, I like to say that the fixed income market does not operate in isolation. That is, and as I go through, I'll also be speaking to some of the common mistakes that we have seen most of the investors who come into the fixed income market. So the market does not operate in isolation. It means that the fixed income market, and because we are looking at particularly the sovereign, and when I say sovereign, it means government bonds or treasury bonds and treasury bills issued by the government or by the state. That market does not operate in isolation. It operates within an ecosystem of what we call the macro environment system. So anything that happens in the economy, indirectly or directly, has an impact on where you're going to see the bonds in terms of how much the government issues to the market, in terms of what coupon they will be paying you, and coupon to mean what interest they will be paying you every 6 months, what tax will be charged on those very bonds. It also impacts the liquidity in the market, meaning the participation of retail investors, who I believe comprise the most on this call, but also institutionals, also people in the diaspora, but also it helps you as an investor to interpret how your bond portfolio is, at what price you enter, at what price you exit, and all that kind of thing. So that's why it's important for us to understand, how did Uganda perform in that particular period? What was inflation like? What did the Monetary Policy Committee decide to set the central bank rate at? What was our currency looking like? How did it perform? What's our public debt in relation to the overall economy, but also what are those external developments and what's the outlook? So just a quick, I'll be brief about this. In terms of the overall, for lack of a better word, health of the economy, which we usually measure by economic growth, or we measure by what we call gross domestic product, that is GDP. Last year, government had estimated that would grow by about 6.5%. And already when we look at the preliminary numbers, we see that the economy did grow by 6.4%. Now that is good, because if you remember, majority of last year, we had a lot of geopolitical developments all the way from the US. We saw a lot of protectionist policies from Trump. We saw a lot of restrictions in terms of trade. So in terms of forecasts, but also sentiment of the investors, you would notice that there was a bit of uncertainty. When that happens, you will notice that investors tend to move away from what we call risky assets, for example, equities, and they move into safe havens. So if you look at all the asset classes that give the assurance theoretically on protection of capital, for example, government sovereigns, if you look at gold, some commodities, they really performed so well last year in terms of returns. So that's, I'm just trying to help you understand how the macroeconomic environment links into fixed income. So given that our economy grew by 6.4%, that was quite resilient compared to how other markets did perform, especially on the global front, but also compared to other countries in the sub-Saharan, we did quite great. Our inflation, the target for Bank of Uganda is 5%, but our inflation last year averaged 3.3%, and much of it was really coming from the agriculture side. So that was a good thing for us in terms of the central bank rate. Now, the central bank rate was held at 9.75%, and just simple economics would tell us that if the central bank rate is high, it means that interest rates in the market should also be high. But they have maintained the 9.75% from October 2024. Yes. So you would see that the expectations for the investors in the market were quite aligned with where the central bank would hold it. And this year, they've so far held 2 meetings in February and May, and they've also held it at 9.75%. Then in terms of our currency, last year, our currency really did well, especially picking momentum from the dollar. The dollar really weakened last year. And you see that our currency for most of the year was appreciating. It touched even 300 3,500 level. We saw our currency get to that point, but we know that the average of our currency usually oscillates in the 3,600 range. Unfortunately, this year, as the Iran war really did peak, you would notice that the dollar strengthened, and that meant that our currency had to depreciate a bit. So if you've noticed, our currency has reverted to the 3,700 levels range. So that's a very key point, especially when you look at currencies for our investors that are offshore, our investors that are abroad. It's very important for you to also monitor that. Then in terms of the fiscal position, what do I mean? I mean, what's the domestic requirement in terms of borrowing? What does our budget say that in terms of borrowing? How much money is government going to borrow from the fixed income market? Last year, our budget, and I'm going to speak about it in the next slide, was about 72 trillion, excluding the supplementaries. This year, it has increased to 84 trillion, and also the domestic envelope has also increased. So it gives us an expectation, as investors in the fixed income market, of the supply or the number of issuances in terms of auctions that will be coming in. And I think Susan will speak about this when you look at the new calendar that government has put out. Then in terms, also in that fiscal position, we also talk about things like that's our public debt. I think one of the issues that someone raised that has stopped them from investing in the fixed income market is the worry that maybe government will not pay should another government come in, another political party. So you start to look at some of those things. What's the public debt ratio compared to the GDP? And I think currently it's at about 53%. And if it's 53, is that good or is that bad? How does it compare to the matrix that are globally prudential for sovereign entities? Another thing to that is to look at the sovereign rating of that nation. I think according to Fitch, which is an external rating agency, I think we are B+ with a stable outlook. Someone can confirm that, but I think that is good. In terms of the oil and external sector, for every investor on here, it's important to also keep watch of government's narrative around oil. It has become more dominant, and I think one of the key themes in the 2026-2027 budget is that you'd see government sort of championing the oil narrative that is estimated to commence in the second half of 2026, in which we are. So how would that in fact impact our fixed income market in terms of the yields, but also in terms of the supply? Now, the next slide speaks about the budgets, how the budget has evolved from last year, the last fiscal year, and how it is looking like in this current fiscal year. But I'll not focus much on the larger narrative. I'll just narrow it down to the domestic market in terms of financing. If you look at the second row that talks about net domestic borrowing, you'll see that it has increased in allocation from 11.4 trillion to about 12 trillion in this current fiscal year, which means that government's expectations in terms of borrowing from the local market, including investors on this call, has increased, which gives the opportunity for us to look at the auction calendar and see which periods are we having the auctions, in which periods are we having more supply heavy issuances from Bank of Uganda. And then if you look at refinancing of maturing debt, please note that fixed income is basically debt. Government is taking your money, promising you a return, which means that they should pay you that return, but also they should pay you your money at the maturity, whether it's maturing in 364 days, whether it's maturing in 2 days. So that's basically what refinancing of maturing debt is. And you can see that it has also increased to 14 trillion. Now, in line with refinancing, you'll start to hear things like bond switches that Susan will also explain. I think in the new calendar, you will notice that there is a bond switch. So what does that mean for you as an investor? If you're holding a bond, you also need to know, if you look at the calendar, is it the bond that is going to be switched? And what does that mean? If you look at the external side of things, you'll notice a bit of reduction in terms of getting money. And one of the reasons that government is giving is that external financing normally has time lags, so it delays to come, but also might be more expensive. So all that basically put together is that still our budget is very skewed towards domestic financing, meaning that most of the portion of financing that for both budgetary needs, but also for refinancing domestic debt is from the local market. And what does this mean is that we are able to, if you look at the trends of the yields, they have bit come off from the peaks that we have seen. But as this information comes, if we see, okay, government has is going to raise this amount of money, but also our country has a tendency of passing supplementary budgets, which also is good for the fixed income market in terms of yield expectations. Note that last year government did issue a supplementary of about 10 trillion. Yeah, so if you add the supplementary, our budget increased from 70 to about 80, 81 trillion, roughly around that. So that's also good because once yields come down, markets start to question themselves, how long is this going to take? Is there an expectation that yields will normalize back to the higher? And why yields are important in the fixed income market is that it works in reverse, which is a bit confusing for some investors, meaning that as yields are high, the price that you pay for the bond is most likely lower. So they work in reverse. The higher the yields, the lower the price that you pay, or that's when you start to hear things that you're paying a discount for a purchase of a bond. And if yields go down, it means that you're going to pay a premium for a bond. Not always, but most likely you'll pay a premium. You'll pay more expensively. Yeah. Then how did the market perform in terms of auctions? Now, the fixed income market, how can investors participate? We have what we call the primary auction. The primary auction is the first time that an investor gets access to the bonds that the central bank has issued. So you purchase directly from the central bank. And then the secondary market is when now you purchase from another investor. So it's investor to investor. Now, primary market, government puts up an auction, says we want to raise this amount of money, and then different investors tender in, and then government accepts within their financing needs. So you see that it was quite robust in terms of acceptance. Now, the darker green is how much government had offered in the various auctions aggregated together. And then the lighter green shows you how much they accepted from what was tendered. Now, I can say that last year you notice that all the treasury bills and treasury bond auctions were oversubscribed, meaning that investor participation was quite robust. People really did tender their money to participate in the auction. However, how much did government accept of what the investors had put? Also, that amount was quite high. If you look at the acceptance to offer ratio for the data that we have collected as of the time of this presentation, you notice it's at a 113%. So 13 times greater than what they had primarily offered or put out to raise. So what does that tell you? That government also had appetite for this debt. Not that last year we had it was a pre-election year for Uganda, which is good. It usually bodes well for the yields in the market. Pre-election years we have seen from the different cycles of election, you notice that the yields tend to peak, they tend to rise, they tend to be significantly higher than years when there are no elections or anticipation of the election year. So government also had that. So you have to keep in mind that it was an election year. You have to keep in mind that there was a supplementary budget that was passed. You have to keep in mind that if you look at our performance in terms of how much government was raising from tax, how much government was getting from the externals, not also how much, if you look at our trends of grants, they have been declining, donor inflows were declining. So you see that put together, the factors were pointing towards increased financing needs. Government needed the money. So you see that there are auctions where government would offer, say 990 billion, and then they take more than that. Yes, so all of that boded well for our yields, as you're going to see in this very presentation. But as we tended towards the end of the fiscal year, if you look at December did not have a treasury bond auction. If you look at January, February, March, if you look at the acceptance of debt from what was tendered in the market, it was much lower. Why? Because government has what I've called front-loaded. It had picked up a lot of debt in the beginning of the fiscal year. So of course, for them to manage the refinancing pressures, to also manage the maturities and the coupon payments they had. For example, they had a coupon payment in February. So to manage all of that, you see that their uptake, as you can see on the graph, sort of declined compared to the earlier months of the fiscal year, which is also good for investors as you anticipate which auction to participate in, but also the outlook for the following months. In terms of secondary market, the activity, quite frankly, is still subdued compared to where we want the market to be at. But secondary market is where investors trade with other investors. So if you've held a bond that you want to sell, it will be sold on the secondary market as long as it's not held to maturity. If you've missed an auction and you want to get access to a certain bond, this is the market in which you participate. So you reach out to your broker. Old Mutual, we have a broker. You reach out to them or to your bank, and then this is where the negotiation happens. And I think this is where most of the retail investors face a challenge in terms of understanding how are you being priced, either to enter, to purchase a bond, or how are you being priced when you are exiting that bond purchase. But usually in terms of yields, the secondary market is basically a reflection of how the primary market has performed. You'll most likely see if yields drop on the primary market, if government issues a bond today and the yields have dropped from where they were in the previous auction, you notice that the secondary market will move in the same direction. The yields will also drop and perhaps even match by a greater difference. Yes. Then in terms of our stock of government securities, who actually participates the most in our government, in our fixed income market as Uganda? Of course, you look at the banks are really the greatest holders of commercial paper, of fixed income or the treasury securities. And even if you've been keen to look at most of the balance sheets of the banks, you see that they are quite earning from the interest on the bonds and the treasury bills. The next, of course, is the pension and provident funds. This is where we have the likes of the unit trust. This is where we have, if you have a retirement scheme, you'd also be keen to look at the capital markets quarterly bulletin. You'll be able to see that our market in terms of investor allocation or asset allocation is very biased towards fixed income. Government securities comprise more than 70% of most of the pension and provident funds books. Yes, so you'll see that it's very concentrated on the institutional side. We also have offshore investors, and I'm going to speak to them in the next slide. But you will see that for retail, my goodness, we are still let me just put this slide. Yes, if you look at the retail, it's just still under 6% or around 6%. So most of the allocation or most of the stock is concentrated on the institutional side. Look at the banks, look at the pension and provident funds. So we have, of course, NSSF. Look at the offshore investors. Offshore investors have also increased. Offshore investors, these are people that diaspora or foreign investors, they are categorized as offshore investors. Also, we have certain investment firms that are domiciled outside Uganda that also really participate in our fixed income markets, and they are also key in terms of influencing the participation levels, but also activity, or also where our yields tend to fall in terms of the fixed income market. So retail, we still have a lot of work to do. It has remained really modest over the period. This is just comparing 2 quarters, December and March 2026. Offshore participation, just look, you'll see the trend that they had sort of bottomed to about 6.75%, 6.7% in 2024, but they have since I think the number has reduced from 15% if you look at June, but you see where they had peaked by January or by even December 2025 at 14.9%, which is good. I'll give you a scenario of what happened early this year. Now, getting into this year, you'll notice that last year on the longer end, our yields had even peaked 17.7, 17.9, secondary market even an 18 was there. Which was good because you would be paying a lower price for some of these bonds. You're booking them at a very good yield. Part of that was that also the offshore investors had really also participated in our fixed income market. I mean, if you look at the emerging markets and you look at our macros and you look at our yields, they're actually quite good yields compared to how other East African or even other African sovereign debt is doing. So it was good pickup. Fast forward to this year in February, you would notice in January, actually, you'll see that government, I think on the 20-year, the yield even dropped to about 14.7, if I'm not mistaken. But yields really dropped. They really dropped. And around that time, we had the Iran war. So the Iran war peaked or escalated in February, March. And then you'd see that our yield started, there was a bit of volatility in the fixed income market. Part of that was that these offshore investors were exiting some of these positions. And then the yield started to oscillate back to the 15 and 16 levels. And that's where now they have averaged to. If you look at this curve here, it talks about how the yields have evolved. Above the red dotted line, you see that's where the yields were most of last year. So you see that the yields were really high, which is good. You'd pick up the bonds cheaply, as I have been saying. And then fast forward to 2026 from January to May, you see that the yields have dropped, as you can see by the curves, the 3 curves that are down and are dotted. You see that one, the elections were complete. So there was that unwinding or gradual reduction of the political risk premium that investors had sort of priced in, which also made the yields peak in the 2025. But also government, if you see in the reports that they do issue, they had financed close to about 90% of their needs. So it meant that they were going to pick up less debt, and also notwithstanding still the liquidity in the market was still high, that the auctions were very oversubscribed. So all that put together meant that the yields would definitely have to decline, as you have noticed. So that's why I'm calling it like they peaked in 2025, but there has been a reversal in 2026. This just shows you how the different yields have evolved at the particular periods of time. Where you're seeing a pink or a red, it means that the yields have declined. That sort of just reinforces my point that we have retraced from the peaks that we have seen early that we saw last year, and sort of now the yields have reduced. If you look at the 25-year, we had a 17% in Q3 2025 when it was issued, and then currently you can see it at 15.93%. And another good one, you look at the benchmark, the 10-year bond, which was at about 16.93 in Q1. Currently, it's at about, and please note that this data is as of June 19th, so a lot could have changed, is at about 15.44%. But the idea is that the overall curve has sort of declined. Declined is not the right word. It has sort of, the yields have declined and the curve has sort of flattened from the highs that we saw last year. So given that, I think I'll stop there, and then Susan can come in and give some of the highlights from the 26-27 calendar, and then the call to your action, and then I'll be taking in any other questions, either in the chat room or as
Thank
our
you so
host will.
much. Thank you so much, Janet. So I'm going to just quickly share the calendar so that we can quickly go through it. Then we shall come back to those highlights as Janet will be displaying them for us. But let me just quickly go to the calendar so that people will also see what a calendar looks like. We couldn't put it in the slides because obviously it would look very squeezed. Yeah, so this is the auction calendar. So first of all, what is a calendar? Because we know we have first-time visitors, investors that have never actually deployed money. A calendar is like a menu, if I would call it like. It's the menu that the government is going to follow from starting from July this year all the way to June next year. So you find that, for example, if we work for us who work in these corporate companies, we find that our financial year starts all the way. We do the normal calendar year. That means from January to what? To December. However, just like Anayo had explained earlier, is that for the government specifically, for them, their calendar is a bit different. For them, they move from June to July, from July of a new year to June of a following year. So you find that right now, this calendar, even if you look at it there, it's telling you that the first auction date that is coming out is really next what? Next week. So you find that this particular calendar is going to carry us for the entire year, and then they're going to specifically, of course, show you the exact bonds that they're going to issue out to you. So the calendar is exactly going to show you what is going to be auctioned. So for example, there are certain bonds, like for example, the investors that are here that have already invested, you're going to see that there are some bonds that are not going to return back, even already they have already removed them. So the government also can either bring back the same bonds maybe they had in the previous calendar of 2025, 2026, or they can decide that actually we can put new bonds out there for them, and not that they are new, they can be new or reopenings, and that is what Janet was really referring to as refinancing of bonds. So going back to the calendar, so you find that we have the treasury bills. So the treasury bills, so we start with, first of all, let's start on the corner here because they are divided up into quarters, and quarters means that every quarter has three months. So quarter one, quarter two, quarter three, quarter four. So they'll be catering for those three months. Then the auction date is always a Wednesday, unless if that particular auction date falls on a public holiday. But every Wednesday of every 2 weeks, specifically for all the securities, it is always on a what? On a Wednesday. Then the settlement date is always a Thursday. That means the government says that prior to the auction, the government is collecting the bids, and they are collecting them through the brokers, the banks and everything. They are collecting them. So as they are collecting them, then they say auction, they first collect your bids. They do not first take your money. Investors, the bank, the Bank of Uganda or the government of Uganda does not first take your money. It first takes your bid. So once they have taken in your bid and it has fallen within the rates or the ranges that they are acceptable to them, then on the Thursday, the settlement date is the day now they pull the money out of your account, and it's the day they credit you with a security, and it's also the same day that the interest starts being calculated. So you don't start calculating interest on Wednesday, you start calculating it on Thursday. That means every day as it passes, your money now starts what? Earning. Now, specifically for treasury bills, the government is going to come for money every what? Every 2 weeks. So every 2 weeks, the government of Uganda will be coming specifically for treasury bills. But if you also look at the uniqueness of this calendar, you will find that actually they're having one auction for the treasury bills. The government is saying we are having one what? One auction. So that means, for example, in the quarter one of that means from July to September, the government is there. That X is representative of when we are having a treasury bill. So they're saying we're having 1, 2, 3. Now, what you need to know that this has actually changed because the government was doing treasury bill every 2 weeks. That means now for this particular calendar, the government is saying, no, we no longer want that much of the short money. We want what? longer term what money, because actually this is really a divergent from what they have been doing, because they have been doing every 2 weeks. That means now you'd expect that in July you would expect 2 treasury bill what auctions, but actually you're seeing that we are having 1 treasury bill auction per month. Are we together? And so you need to note of those specific dates. So now you see, now we had it in our heads that it's every 2 weeks. So that means if I miss out a treasury bill this week, I can be able to come for it in what 2 weeks later, and I'm able to what to buy. But that one has clearly changed. Going forward, we're going to just be having that one auction for the treasury bills. Then now when we go to the bonds, now the bonds for them, they will display them out, because for the treasury bills, really the rate that is given, that is the rate. However, for the bonds, they will specifically tell you what bond they are issuing out, when it is maturing, and the coupon that is paying. A coupon means the cash flow that the bond is going to pay you from the time you buy it till the time it matures. A coupon is a cash flow that you're expecting from the government of Uganda every year. In fact, the government goes further ahead and divides that annual coupon into 2, so that they make sure that every 6 months you are expecting money from the government of Uganda. So for the 2-year bond, they are clearly showing you now. And I was telling you about refinancing bonds, like those are reopenings. That means these bonds were already in existence. It is not that they are new bonds. Now, for example, that 2-year, and how do you get to know reopening bonds? When you see that there are rates on them. If you see from the 2-year to the 5-year, to the 10-year, to the 15-year, all of them have rates on them. That means those bonds are not new. They have already been in existence. For example, that 2-year bond was issued out in 2018. It was originally a 10-year bond, but right now it is left with what? About 2 years to get matured, and that's why they have returned it as a 2-year bond. And actually, this particular bond will also attract a 20% tax. What you need to know that all bonds that are below or less than 10 years attract 10% what? 20% tax. And that particular tax amendment took effect in 2019. So all bonds that were previously auctioned 2019 and the years below, those bonds still attract a 20% tax, except when the government comes and tells you that for this particular bond, yes, it should be paying 20% tax, but we are going to what? We're going to issue out a 10% tax. And they were able to do that in the financial year 2024-2025. There was a bond that is a 2029 bond that actually we're going to look at very shortly right now. 5 years, so that means it pays 15.25%. So from the people who bought into it in 2018, and you who's going to buy it right now, this 2-year bond, all of you are earning 15.25. The difference is at what price you buy it. You get it? You may find that probably for even it could be issued out and you buy it cheaper than the person who bought it maybe 8 years ago. You get it? Or it could be that the person who bought it 8 years ago is buying it more cheaply. So what is the difference between you and the bondholder who bought earlier and you is the pricing. But other than that, the cash flow is the same for all of you. Then, and even the days actually when the money is paid, the coupon dates, the exact day when the money is paid is also the same for all of you. The 3-year bond is the 6th of July 2028 bond, and they're telling you that pays 15.550%. Meanwhile, this 3-year bond came out last year, in last year's calendar, if I could say, if last year's financial year, that means last July is when we first saw this bond. Actually, it came out on the 7th of August 2025. And during that time, that 7th August 2025 is when this particular cash flow of 15.55% was determined. So until 2028, it's going to pay until 6th July 2028 is going to pay 15.55. And I know people will be like, but now the other one of 16th November 2028 is longer and it's paying less. When bonds are issued out at different times, because different, like Anaya was telling you, different pricing is happening in the market. I mean, we had elections coming up. We had the wars that were coming up, that were also happening in the strait, and all those things will speak into the rate that is going to be issued out. Then this one, the 5-year bond, it pays 15% and it matures on the 20th of May, 2032. Yeah. Then the 10-year bond, this 10-year bond actually they had brought it in the year of 2024, 2025. And actually at that time they had brought it as a 15-year bond. But now the government has said now we are returning it in this particular calendar and we are returning it as a 10-year bond. So that means the people who had bought the 2035 bond, isn't it? A 2035 bond that paid how much? 16,250. You're no longer going to have access to it unless if you have some money right now, quickly, you can talk to the brokers and they negotiate for you on the secondary market and they buy for you. But other than that, you're going to be buying this one off from the government. The 15-year bond is the same. They have not changed it, but however, they're going to change it, and I'm going to show you how this calendar actually has surprised us. It's really interesting. It's a new of its type. We have never seen such a calendar, but we thank God for it as well. The 20-year has also been the same. 2043 pays 15%. So you see that the 15-year pays more than the 20-year, and that goes back to when were they issued? They were issued, this one was issued in 2023. The other one was issued, I think, around 2024. So at the different times they were being issued, that is what resulted into the what? Into these different rates. So in 2023, this one came out at 15. In 2024, the 2039, because this 2037 was going away and we needed a new 15-year bond, this one had to come out at slightly 15.8%, and it was because of the prevailing rates then. Then the 25-year bond is also back for those who had bought it last year. It's there. So if you want more of it, it will be available for you at the auction. 16% is what it pays. It was issued also last year on the 7th of August, 2025. Now, the interesting thing about this bond, you'll find that they are going to issue the 2-year is going to remain as is until next year. But then they are telling us that on the 3-year bond, this 3-year bond, we are going to stop issuing it out in what? In August. This one of 15.55, and we are going to issue a new bond. So starting September, we are going to get a new 3-year bond. We're not going to continue with this 2028. The same goes to the what? The same goes to the 10-year what? The 10-year bond. They are saying that 10-year bond, the same goes to the 15-year and the 20-year bond. They are saying that this particular bond, the 15-year bond, is also going to stop around the month of what? Of September. The one of the 20 years will stop around the month of August, and then we are going to issue you a new security that is now going to take on the life. Now, the reason that could be is because, first of all, since these particular bonds, especially the 20 and the 15-year bond, ever since they issued them out, they have been appearing on the calendars non-stop. So you find that probably the government has also accumulated an outstanding debt on those particular bonds. And sometimes when the government also over accumulates, then that's why they will resort into things called a bond switch. And that is why you're saying here that on the next year, on the 31st of March 2027, they are going to do what is called a bond switch. This bond switch has begun in 2021 when before the election year. So bond switch, what does it mean? That I am a holder of the 23rd of August 2029 bond. I hold that bond currently. But the government says, you know what, Susan, can you come and switch out that particular bond? Can you come and give it back to us? And then for us, we transition you into another bond. So they'll give us an array of bonds that we can choose from. Sometimes they can put these particular bonds that are currently at the auction, or they can even add 1 or 2 bonds that probably may not be on this particular calendar so that they are able to attract the investors. So they're like, you come and switch out. So only the people who hold this particular paper of the 23rd of August 2029 are going to be given that opportunity. And really, that usually happens when the government has also accumulated a large outstanding on that particular date. And so you find that as we are heading towards 2029, and they are saying, hey, we're going to play out maybe close to 3 trillion in the market. That is flooding the market with money. You get it? Eh? So they would rather that they contain some of that money and it is held back in longer bonds, in maturities that have a longer period, so that they do not have to pay out a lot of money come the 23rd of August 2029. Then also looking at the calendar, just like Anayo was sharing, that, by the way, the yields have started what? Dropping. And now that even we have had the war, you know, we have now a peace deal that is in place, though it's a bit shaky, but at least now it gives a bit of more confidence to investors. The prices, inflation is no longer going to rally up. Maybe we shall have a slight adjustment in fuel, though they say that, of course, this could take about a 6-month to 12-month period for the adjustment because they had already made purchases. So you find that right now the government is really is not in the mood of paying out a lot of what? Is not in the mood of issuing out high coupon bonds with high yields. Because when you have a high coupon and then you also have a high rate that you're buying at the bond, that means that your government is offering you discounts, isn't it? That means if you look at, of course, government is the borrower. Imagine you're the borrower and you're paying out rates of 17.9, 16%. That's really expensive debt for the government of Uganda as they are running the country. It's really expensive. So you find that the government wants to start tappering and saying, you know what, we want to, maybe, yes, we can go down to the 14% ranges, 13% ranges. So that is why it's an opportunity now for those that have their money to, you know what, to start plugging in and getting some of these securities. You can get them off the primary, the secondary market. They are there, especially for the high coupon bonds, because you see clearly the government is communicating, I no longer want to pay as expensively. Then also Anayo was able to share. Anayo, maybe if you could share back the slide, the last one. Anayo was sharing about fast oil. When those taps start flowing with the oil, remember the government is going to already have another source, isn't it? Already Janet explained to us in the presentation that already gold was performing well, coffee was performing well. So we were getting a lot of inflows that were coming into the economy. So you find that the government wants to diversify away from us, isn't it? That we have been giving them money, but it's expensive money, isn't it? So they want to find other sources of what? Of money to be able to what? To reduce the rate at which they are borrowing. So just like I think the things that we are highlighting there, the auction frequency for the treasury bills, we have been having 2 of them, but now maybe I'll start off from the top. The new 3-year benchmark bond, it will be there up to September, and then after we shall go for a new bond. And then also the same with the 15-year bond and also the 20-year bond. Then also you need to know that the tax is also changed. The tax is anything less than 10 years will be 20%. Anything above 10 years will be 10% unless the government tells you otherwise. The auction frequency has also changed. Yeah, we used to have 2 treasury bill auctions. Now we are just going to have the one, and then we are just going to also have the one bond auction as well. Then the 10-year bond that we are having, you find that for it is a slower coupon. We had 2035 that was paying 16.250. Now we have this one that is going to pay 16%, but both pay in May and November. And then you see that our coupon profile for the people that love laddering and the ones that were asking about laddering, the coupon dates that are available for us on this calendar are majorly May and November. Actually, May and November is really outstanding. Then we have January, July for the 15-year and 20-year, but that bond of 15-year and 20-year, I think it's up to 2032. Then after they transition into June and December. Then the February, August is coming from the 2020, the 25-year bond. That is where it's coming from, that particular cash flow. Then we shall have March and September, April and October, because you see, actually we have one April and October bond, and it's a bond that matures on the 3rd of April 2031. But you find that now government, you see, has extended certain auction periods down around the months of September, October, so that they also can create some cash flows around those months, so that they are not also heavily burdened to pay money, because a lot of the money is being paid out in January and July and May and November. So government is saying that that needs to change. Then bond switch, I've told you, anyone who has this particular instrument, if you want to switch it out, please prepare. You'll receive communication from your brokers that the switch is coming up. And if you have it, you can be able to submit it in, and they'll give you another bond. The yields and coupon relationships, and I think this is something that we shall also have another discussion about. I know we taught the investors earlier, but I know it's something that people really want to understand. And you are saying bond pricing Actually, this is what makes the bonds, the yields and the coupon. The coupon, like I've explained, is the fixed cash flow. Come and buy up to 2025, you're going to be paid 16%. But yield, which is also a percentage, is the one that determines the price. But that one keeps changing. So for example, you find that the 25-year bond, when it was first issued out, it was at 16. Then in the next time when they issued it out again at another auction, it went up to 17. Now it is back into the regions of 16. On the secondary market, actually, when you want to buy this 25-year bond, you can maybe get it at 15.9. So you find that the coupon is the same, the cash flow, but the rate at which you're buying and which is going to determine the price. Well, that means it's going to determine whether you're paying a premium price or a discount price is that particular rate. And that particular rate is really pertinent for the performance of the bonds. And however, like we always said, even in that presentation and how we taught and how we are going to teach, we can do another session for your investors, is that premiums are not bad. Because remember, you have the cash flow, isn't it? So you want to enter the investment. So people are saying that, I'll wait for the discount environment. You may have to wait a very long time. So the best time for investment is always now. Yes, Janet, the next slide. So for the opportunities, the investors are well positioned and to be able to partake of the opportunities. Usually we like to tell our investors that, you know what, partake of every auction, just usually the minimum to invest in government securities, in government bonds particularly, is 100,000 Uganda shillings. However, maybe if you want it to make a bit more sense for it, could be maybe 1,000,000 shillings. But if you have 100,000, approach your broker and make sure that in every bond you're participating. Because if you say that I'm going to wait for rates to go up, they may never go up. And that is the advantage. When you're a bondholder, personally, I'm an investor as well. You find that when you buy the different bonds at the different rates over the different periods of months, you'll find that now you get to average your cost, your overall cost that you are paying to the central bank to be able to buy these bonds. So that means you're able to partake of months when they are high rates, then you're also able to partake of months when there are very low rates. So ultimately, you'll be able to average. We have that challenge of I am going to wait. And that waiting, because this is not a market we are speculating that now we are going to get 15, now we are going to get 16. You'll find that, just like Janet explained, when the central bank releases that central bank rate, then these yields and how we'll start following that rate, isn't it? The appetite, the information that is hitting the markets. So it is very important, spread out your money. The government is not even going to arrest you that you're overbuying bonds. No, even though you want to buy every day, no one is going to hold your hand as long as you have your as you have your money. Then of course, as we have been seeing, really the government is really keen on not paying as much as they have been paying. They believe 16%, 17% is really steep on them. So you're going to see that for those ones who to be able to manage expectations, so that you're not telling your brokers, now you're giving us these bad bonds. They're not the ones giving you bad bonds. It is just the market now. The government is realizing we are paying way too expensively. Yes, it's clearly the domestic market has demonstrated to them that actually they can get the financing they need, but actually they need to get that financing at the right price for them to be able to run the country. So you'll find that exactly you'll start then seeing that the different bonds will be at different rates. Partake all of them, like I said. There is no sin in having as many bonds at different rates. Then of course there are sukuk bonds that are coming up, especially for the Muslim community. They have also been saying we want also bonds that we can be able to invest in. So the sukuks are coming. We know that regulation is being worked on, and hopefully it will be finalized, and then we shall be able to have these issuances of the sukuks. Then of course just keep looking out for the market. That oil production is very key. The moment we have fast oil coming, then you know that those rates are not going to be as they were before. So I beg to stop here and hand over to Bob.
Yeah, thank you very much, Susan and Janet, for this comprehensive presentation. I hope to our audience One, you got a chance to appreciate how 2025 was and some key insights into 2026. I know Susan has really, in her presentation, touched on a key aspect around laddering. Because I'm just relating this to the questions and comments I'm seeing in our chat and Q&A. I saw people were interested in knowing what is laddering. So I believe in that last presentation, it really refers to you trying to purchase bills and or bonds and organize them in regards to when they pay out. So really, I hope that came out clearly, and I believe Susan really did justice on that. Susan, I believe as now we are in our Q&A, so we are starting with the questions in the chat. If you have anything to really inquire about, the chat is still open. I see people were asking about switching and switching. What does it mean? Is it a must? What do I do if I don't switch? I think that's where we'll start from.
It is not a must to switch your bond, because when you are buying it, you wanted that particular period. For example, you'll find that you said, I will need my money back in 2029. So it's not a must to switch. And that's why you see even the results for that particular bond switch auction, they will give you the results. They will tell you that we switched, they'll tell you the amount of money they were able to switch. So how much they received back in those and how much they were able to switch. They'll be like, maybe we had an outstanding of, say, maybe 2 trillion and we have been able to switch out 1 trillion. So that means 1 trillion has remained with investors who do not want to switch. So it's not a must.
So thank you very much, Susan. So to the investors, it is not a must that you switch. Of course, you're encouraged to switch. And switching really is migrating from one bond to another based on government's decision. So you as an investor, you can't choose to switch unless if you sell and buy another one. It's only government which initiates and says, we would want people who have holdings in bond A to opt into bond B and leave your position in bond A. I believe, I think that covers what is switching. I will also request my colleague John and Kyle. I know we had a previous session on yields and pricing. If you could post it into the chat for that particular video. We have seen a lot of interest on people who want to know what yield is, how different yield is from price, and their relationship. So I'll ask my colleague Kyle, and we'll put it into our chat, and you can pick it up on our YouTube channel. So really, in the interest of time, I think that's how I will address that. Janet, this is for you. Why does BOU participate in the market? Because I think on one of your slides you showed us that Bank of Uganda is a participant in the market. So over to you, Janet.
Thank you, Bob. And also Susan will have to complement my answer. But one is, look, the fixed income market economically is also used by government to sort of, what they call it, for lack of a better word, it's also it's a mechanism that they use in terms of the supply and the demand of money in the economy. Now we have things like government issues, but also government can purchase treasury bonds from the market. Now, the obvious answer is why they participate is that they're the issuer. They're the issuer of the sovereign debt. That is the first one. Two, also, the other angle is that government is also allowed to buy back bonds. That is very common in the Kenyan market. If you've seen the Kenyan market, you'd also notice that they usually also do buybacks from the treasury, from the market itself. So that's the simple answer, but let Susan give more details on the Ugandan side.
Yes, yeah, they do. And also sometimes it also Bank of Uganda does have they, like you said, that they get to be they are able to buy back this money, and also maybe more of like an investment, but also to partake of what is being issued. But I've also seen that there are also instances when also the central bank itself does issue securities as well. So it's also in a bid to also beef up their own operations when they also need their financing. And so they're also able to do that through the government securities. So really, majorly, they are allowed. They're also an investor, the Bank of Uganda. Remember, the government of Uganda, who issues out, who is the issuer of, even where does the calendar come from? The calendar comes from Ministry of Finance through the debt office. So the debt office is the one that appoints Bank of Uganda as an agent. So Bank of Uganda here is an agent to the government, to the ministry, to collect money from the what? From the economy on their behalf to be able to run the different operations. So that means even the agent can be able to what? To be an investor. But also even sometimes the agent is also allowed as well to be able so to issue certain securities, especially when they are raising also money for their own operations. Yeah.
Okay, thank you, Susan and Janet. I think, Susan, I will request you post for us a link to the calendar, but it is available on our own website and in our application, I think from tomorrow, even on our Easy Portal platform, you'll be able to access this calendar. So I see there have been really a number of comments on the access to the calendar. Now, Susan, this is to you. Are certificates issued to bond holders? And do I need to go to my broker to access the certificate?
They no longer issue certificates for any security in the market. That used to be the operators, they used to do that type of thing before. That is even for shares, but now that is no longer the case. So right now, when you buy your securities, they are deposited directly into your account. So for those that buy through brokers, you'll find that even then you're able to see your securities being reflected on your SCD. Actually, there are certain things that also we are finalizing with BOU that is going to make that process even more seamless for our customers. And actually, you're going to be able to access them just like you're doing on the Easy Portal, you're doing with the equities and everything. But currently, you can still see them and view them. We're now going to even introduce an app very soon that will be launched. And then it will be very easy for you to see the government bonds that are running. They should be able even to tell you the coupon cash flows that should be coming out for the different securities. Yeah.
Okay, so thank you very much, Susan. I think the last one. Okay, no, I see there are still some other questions. We have about 8 minutes to close off. So just a quick one for Janet. Premium versus discount. In just a few words, how do you differentiate them?
So a discount, just like the word sounds, is that you pay less than you pay less. For example, if you want to, at the end of 2 years, you're purchasing a bond that would give you 100 million. Right now, you would pay, say, 97 million. And then for a premium, you would pay 102 million, higher, an amount that is higher than the face value or the nominal that you'll be getting at the end of the tenor or the maturity of the bond. That's it simply.
So thank you, Janet. I see we have about 3 questions from Josephine. Susan, these are quick ones for you. So Josephine is asking, for reopened bonds, is it a given that the coupon rate will change for new entrants, or does the central bank maintain the rate that was given at the beginning?
The coupon does not change for new entrants. So, and that's why you see even in the calendar, they go ahead to place to indicate those coupons for you. If they were going to change, they were not going to indicate them. Even on the invitation to tender, they are there. So they are showing you that from the beginning up to when it will end, the moment it has been issued on its very first day. Like, for example, that 25-year bond that you saw and the 3-year bond, they were issued last year. That is why you see they have the confidence to tell you that I'm going to pay you 15.5%, even though you're entering this July, even though you're going to buy in July, they're going to pay you. Yeah.
Another one for you, Susan, is from Josephine saying that how can she easily reinvest in a bond, especially using her coupons and extra earnings. So she wants to maintain the position in one bond. How would she go about doing that?
Yeah, so now for all our investors that are under brokerage firms, so you'll find that and our brokers, who are our brokers, by the way, for all our new investors, we have Dare and Blair, and I'm going to quickly drop in their contacts shortly. We have Old Mutual Uganda, and Nayo is an analyst from Old Mutual. Then we have Crested Capital Uganda, and then we have other 2 brokers that are also finalizing their paperwork to be able to join. But those are the current 3 brokers that where our clients are investing. So what happens that 1 week prior to the coupon coming, because we know that when the coupon is coming, that dates, even the contract notes that the brokers will share with you, they'll be indicating that exact date when the money is coming and how much is coming. So usually they communicate 1 week prior to the maturity, and they ask you, dear Josephine, your coupon is coming next week. Do you want to reinvest or do you want to be paid? So it is up to you to decide if you want to get paid or you want to reinvest. So when you tell them reinvest, then they go ahead, they ask you in what security are you investing in. So you must be clear. Also, are you reinvesting in that particular bond, or you can reinvest in another bond, or you can reinvest in shares, or you can even reinvest in T-bills. So even the money can be used even to cross over and go into even equities if you want to invest, for example, in shares, if you wanted an opportunity. So it is up to you. And or even you can tell them, you know what, you're going to invest that money, but I'm going to also send you a top up. So you can send your money quickly. You can use bank or you can use mobile money, and you send the money and they'll be able to aggregate that money together to be able to make an investment for you.
Okay, thank you, Susan. So I see here a question. Somebody's wondering, I think it's Gloria, that what would happen if a brokerage firm closes? What happens to the bondholders and their holdings? So Gloria, this, you see, when you buy bonds or any other securities on the exchange, they are kept within your SCD account. And the SCD account belongs to the investor. So you, Gloria, let's say as an investor. So if the broker leaves, then it means your agent has left, not that your account has left and gone with the broker. So what we normally do is we give you an option to select a new broker or who is still on the market, or you're advised on which broker would, let's say, for example, be taking up the business of that broker who has ceased operations. So nothing happens to your holdings. What would basically change is who your new agent will be. So you shouldn't really worry about that. I think we talked about the SCD. I've remembered somebody was saying, what's the difference between a CSD and an SCD? Susan, I don't know if you can clarify that.
Yes. So they're actually the same thing. They are both depositories. A depository is what? A depository is where these intangible assets are kept, things that we cannot touch. For example, if you have your land, you have your land title. But the depository is meant to keep intangible assets, things that we cannot hold. Now, the CSD is the Central Securities Depository Account, and that is to be your Bank of Uganda. And then the SCD is to the Uganda Securities Exchange, and it's also called the Securities Central Depository. So it's just an interchange of the what? of the acronyms, but it is one and the same thing, like what they function as. So there's a depository at the Bank of Uganda, and then there's also a depository here at the Uganda Securities Exchange. So for those who already have an SCD here at the USE, you will notice that you're able to buy shares and they are kept there. You'll notice that you're able to buy your bonds and they are kept there as well. They are reported on that particular platform. And actually, there is something that maybe Bob will be sharing us towards the end about even how we are going to further our relationship with the central bank as the Uganda Securities Exchange. Now, what happened is that, of course, the Bank of Uganda is celebrating 60 years in existence. So it came much earlier than us. And also for us, we are celebrating next year 30 years. So we are halfway of the central bank. So that means when the USC was starting, that means already CSD was existing. So that means that is why now it had to change to SCD. Yeah. But they are all depositories meant to keep those intangible assets that the investors own. Yeah.
Okay. So thank you, Susan. I think the last one we'll deal with is for somebody called Brighton. I think he's a student at MOBS. And he's inquiring on how do we support them as students and how do they get to learn about the markets? Actually, I would say, Brighton, you've asked the question of the day, and the answer is something you should be looking out very soon. We have an engagement for universities and students like yourself, and we always call it a university challenge. Really, it is an introduction to you students on how the markets work. We even give you an opportunity to play in a virtual setting as you try to see how actually people make money, and also the other side lose money on the markets, and you learn the do's and the don'ts, but in a kind of a competition nature. And we even actually recognize people who have done well in that particular exercise. It is something you should look out for, I would say, in the very near future, and you'll be seeing interactions with part of our teams at the university. So it is really 11:30. We always don't want to take more than this time. We continue to thank you for engaging with us, for creating time to come and talk to us. I believe my colleague, for some of you who you can check in the chat, my colleague John has put in the link to our YouTube channel, especially for people who are interested in yields and coupon and what it means there. Some of the topics we covered in our previous sessions. So please feel free. Even the recording for this engagement will be added by, I believe, by end of tomorrow, close of business tomorrow. So please take some time, 10 minutes, 20, educate yourselves and learn. I think I saw a colleague who was also inquiring about how to open an account. We gave you the channels. You can go through to open an account. Susan couldn't have said it better. Investing starts now. So I'll give Susan and Jeanette just a minute each, your parting shots, and what you'd tell our investors. Somebody said, what advice can you give them as a group? What do they need to do to also profit from investing in bonds with your parting shots? Susan, you're muted.
Yes, yeah. Maybe I will go first. Number one, we always encourage our investors to first and foremost reach out to a broker, who is a licensed financial advisor. You know, in Uganda, we have run into the challenges of buffet, for those who know, whereby you go and give even these get rich quick schemes. I hear network marketing things. You're able to deploy your money, very good money, by the way, and you lose it there. However, we have brokers that are licensed, just like Janet comes from Old Mutual Uganda, and they are licensed and they are fitted with analysts that are able to give you that information that you need before you make the investment decision. I always tell the clients, at least before you make the first investment, visit the broker, open the account from there, get to know who your contact person, ensure that you're added onto the mailing list, because there is no way that the analysis that Janet has shown here, she's going to just put it out there. The only way she puts it out there is through a mailing list of those other investors of Old Mutual Uganda. They're the ones who are going to receive it. Then after that, get the bank details. When I want to purchase, what is the account, and that account prove that yes, it is in the names of the company and not in the names of the what from an individual. And then be able to make your first purchase instructions. You can even fill out your paperwork, and you get a sense of how it feels to make your first purchase paperwork there. Then after, you never have to return to a broker's office. Every other thing they are coordinating through through emails. And further on, what we have done as the Uganda Securities Exchange, we have the easy portal. Last week I went and visited a friend of mine who was also an investor on the USA, and she had attended the previous webinar, and she said, Susan, come and help me and show me. I went to her and I showed her how to navigate the US easy portal. It's very easy. She had her shares and says, now I wanted to sell some value, and she went and clicked immediately. We put in the sell. We on that easy portal, we're able to instruct a sale of shares. We even reached out to the broker, and the broker had received the instruction. So you never have to go back to a broker's office. The broker will communicate everything via email. If you see there is any non-communication, please reach out to them. First of all, most of them are able to share their personal numbers. And then your investment journey is going to be smooth, because remember, when they know that Bob always wants an investment, they always check on you. Bob, by the way, there is something in the market. Are you interested? But if you're an
Thank
investor
you,
who is,
Susan.
oh, thank you.
Yeah,
The
your
market guy.
minute is done.
And the passionate one.
Yeah, but thank you
Yes,
very much
thank
for
you.
your time and
Yes,
your words of
yes.
wisdom. So to Janet, the group, I think Susan didn't talk about it. The group, they're saying, how can we make it work for us?
Thank you, Bob. Thank you, Susan, but also thank you to everyone that has attended this conversation. Mine are just two. One, just like Susan has said, please do find an investment advisor, a licensed one, so that your money is not lost. Two, how can you invest as a group? All the information that we have provided today is not limited to a retail or to one individual. It cuts across groups, organizations, whether it's your circle, whether it's your chivina, whether it's any form of arrangement, as long as you have funds together, whether they are pooled as a group, you can still participate in the fixed income market. You just have to reach out to one of your consultants, and then they'll walk you through the step-by-step process. Otherwise, thank you so much for this opportunity. Keep planning and then keep invested. Thank you and have a good day.
Okay, thank you very much to everybody who has been part of this. The series are not stopping now. You will be advised on our next topic and when we'll be holding that. But we thank you for being a good audience. Let's invest. Let's plan to invest. The new season for government securities is just starting. So we look forward to the next discussion where we'll have most of you indicating you have started investing. Thank you and have a blessed week and the rest of the week.
You too.
Until
Thank
next
you so
time.
much.